SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF-Baffi Bocconi webinar on government bonds, unsafe assets. US and major EU government bond markets have been traditionally viewed as safe havens. Liquid and well-functioning markets for government debt are key for the real economy. They allow governments to perform vital tasks, and they serve as benchmark and basis for financial markets in many ways. More recently, sovereign bond markets have, however, become focal points of market stress. The smooth functioning of sovereign bond markets critically rests on at least two factors. First, trust in governments' ability and willingness to honor their obligations, in other words, sovereign debtors' creditworthiness, as well as adherence to the rule of law and to promises made in the past. Given that most sovereign bonds are nominal assets with nominal fixed coupons, investors' trust also crucially requires trust in the stability of the currency. This includes trust in the central bank's commitment to maintain low inflation, thus the internal value of the currency, and for foreign investors, trust in the external value of the currency, thus in the exchange rate. Any government measures which potentially weaken any element of this trust conglomerate, such as excessive debt accumulation, measures that weaken potential output and thus debt sustainability, fiddling with central bank independence, or messing with the exchange rate, may slowly or even abruptly weaken investors' appetite for government debt and ultimately even trigger financial turbulence. The second set of factors relates to more technical aspects of market functioning, the intermediation capacity of dealers, which often form part of banking groups. Since the GFC, this capacity has been pressured by various factors, such as strong growth of government debt, the growth of non-bank dealers and leveraged investors, and more recently, a shrinking central bank footprint due to QT. Recent stress episodes, such as the jump in US repo rates in September 2019, the dash for cash triggered by the onset of the COVID-19 pandemic in March 2020, very high volatility in April 2025, and the mini-budget crisis in the United Kingdom in September 2022 highlight the fragility in trading conditions of major markets. The two aspects are, of course, closely linked. Technical market frictions can, if not solved quickly, imply a serious blow to sovereign bonds' status as safe and liquid assets. Conversely, a deterioration in sovereign bonds' economic fundamentals can render the smooth running of sovereign bond trading difficult to impossible. Sovereign bond markets are facing headwinds in both of these dimensions. While today's webinar will mostly focus on the second set of factors, the more technical factors, we are all aware of the elephant in the room, I use the plural on purpose, of deteriorating economic fundamentals underlying sovereign bonds. Before we enter into the core of our discussion, let me thank SUERF fellow Martin Scheicher, advisor DG Horizontal Line Supervision at the SSM, the ECB, for organizing this seminar. And let me give a warm welcome to Karolina Ekholm, Director General of the Swedish National Debt Office, who will introduce our panelists and moderate the discussion. Martin will start out with a short presentation and an overview of the topic. Without further ado, over to you, Martin.
Thank you, and good afternoon also from my side. As Ernest has just explained, the government bond market is a core component of the financial system, but, and this is sort of a major recurring theme in our discussions today, it's inherently fragile because bonds are not traded on exchanges. They are traded bilaterally outside these exchanges. And so somebody needs to bring buyer and seller together, and this is what the dealers do. So in contrast to, for example, the stock market, the bond market continues to rely on dealers, typically from big banks. So market functioning depends on the capacity of these dealers to intermediate or to make markets. In my presentation today, I will give a very quick overview of the background on government bond market liquidity and how they function, and then also set out the main themes for today. Let's take a closer look at bond market functioning in the US and in the EU. So I put the two regions together here. In blue, I show what at least I think is the theory of how government bond markets work, and in red, the practice and reality. So as a safe haven, government bonds should have very low credit risk. They typically do. And in the language of asset pricing theory, they should be information insensitive. But what we have seen is, in particular, in the Dash for Cash episode of March 2020, when markets moved to a risk-off mode, bond prices actually went down rather than up. So there was no, so the safe haven effect was very weak, and rather than buying government bonds, many market participants actually sold them. Recently, we've also seen evidence, and there is quite a lot of literature on this, of the convenience yield in government bonds falling, so the money-like property of government bonds declining, and as an additional risk indicator, CDS spreads are rising for many government bond markets. So these provide some evidence of changed pricing of government bonds, and therefore also really raise the question of whether government bonds still provide the risk-free rate, which is sort of the most important variable in financial markets. Second, we would expect government bonds to be traded with robust market liquidity driven by resilient intermediation. Now, in practice, what we see here, and I put some details here on the lower part of the slide, is market liquidity is actually very sensitive to volatility and depends on dealer conditions. In particular, we see here also an impact of the, of course, overall highly positive regulatory reforms. So banks hold much more capital now, which of course is very important for financial stability, but there have also been some side effects. In particular, we have seen that the US leverage ratio has reduced bank dealer capacity. In addition to bank dealers, we are also seeing major growth in the non-bank dealers. So these are in particular the principal trading firms. They provide additional diversity in market making, which in itself is also a positive development. But the problem is they only have limited warehousing capacity. So if a lot of clients want to sell their bonds, then the principal trading firms may not be able to step in and really stop this huge tide. So overall here, the bottom line in this type of market liquidity analysis is we've seen multiple stress episodes, and in particular requiring central banks to step in. And this is also one of the challenges, in particular from the side of the policy for central banks, because the market function purchases, as the terminology is in the US, might somehow be in conflict with the monetary policy. In particular, with rising inflation, it's not always very easy to convince the market why the central bank is now buying huge lots of government bonds. Another breakpoint in the functioning of government bond markets is the infrastructure, which should be efficient and resilient. In practice, there are significant challenges. In particular, trading is fragmented across many platforms. We still have a high share in some smaller markets, in particular in the EU, of voice trading, so people really picking up the phone, and a high share of bilaterally cleared trades, in particular in the cash, but also in the repo market. There is slow progress in the effective publication of trade details, so transparency is a challenge. Another dimension is similar assets should have similar prices, but the integration of the different segments which are relevant here, cash, repo, futures, and CDS, is not always very smooth. So from the infrastructure perspective, we see significant settlement, liquidity, and operational risks. Then a well-functioning, stable market should be underpinned by a diversified investor base. And what we have seen here over the last few years is not only the entry of principal trading firms, but also hedge funds being very active. So this what the market terminology calls fast money. So these are very price sensitive investors. And if there is a lot of volatility, these types of firms may also cut back on their activity. And just to give one number to illustrate this, there is this estimate for the size of one specific type of trading strategy in the US. This is bond versus futures arbitrage. And so this is estimated at a volume of 1 trillion. And overall, as Ernest also mentioned, of course, if government bond markets are supposed to provide smooth sovereign funding, then the sound fiscal policy is a hugely important driver. And here we have seen very high growth in sovereign borrowing, which is really challenging market capacity and might at some stage overwhelm them in a more general term. So I've tried to highlight some of the different aspects of bond market functioning. So overall, we have at least 6 different themes for today. The properties of safe assets. This is a discussion which is particularly relevant for the EU with the question of national versus EU-wide safe assets. The second one, in terms of secondary market function, market liquidity, and the role of the dealers. On the right-hand side, I show a chart for the evolution of one indicator of market liquidity, which has quite significant deteriorating trends since basically COVID. And if we look at the last few weeks of this type of indicators, we see a further deterioration in this market. Third, of course, the role of infrastructure, in particular the discussion on, which is also active both in the US where it started and now also in Europe, on central clearing of bonds and repos, the issue of transparency, and last, the policy dimension. So on the one hand, central bank policy, what can central banks do to foster this hugely important market? And then, as Ernest mentioned, of course, fiscal policy as the gray elephant in the room. And so these are some of the themes for today. And I would now hand over to Karolina to start our panel.
Thank you, Martin. A very warm welcome to this webinar also from my side. Today's topic involves themes that I can very much relate to in my role as the head of the Swedish National Debt Office. We've actually had a debt stock that for quite a long time has been shrinking in relative as well as absolute terms. That means that we have been forced to deal with problems of poor liquidity in the market, especially during the period when the central bank was conducting quantitative easing. So our market makers have had to handle a rapidly shrinking float as well as the effects of changes in regulation after the global financial crisis. Today, things are a bit different. There has been an improvement in liquidity related to the end of QE and the start of QT, which also takes place here in Sweden. Also, the government's borrowing needs has increased, for better or worse. It has increased the supply in this market. On the positive side, still several of the underlying factors that we are to discuss here today are still at work also here in Sweden. So I very much look forward to hearing what our distinguished panelists will have to say on today's topic. It is with great pleasure that I will introduce our 4 highly distinguished panelists to you. To begin with, we have Zornitsa Todorova, who leads the Thematic FICC research team at Barclays. She's based in London and covers topics such as market structure, innovation in financial markets, and emerging macroeconomic trends. Before joining Barclays, she taught risk management and investments at Bocconi University, from which she also holds a PhD honors degree. Then we have Michael Fleming, who is the head of capital markets at the New York Fed. His primary research interests are market microstructure, financial intermediation, and monetary policy. Recent work of his looks at Federal Reserve liquidity provision during the pandemic, the evolution of treasury market liquidity and its drivers, and the effects of market structure changes on intermediaries and market quality. He's very well published and he holds a PhD from Harvard. Further, we have Matt Roberts-Sklar, who is currently head of Sterling Markets Division in the Markets Directory of the Bank of England. He has previously held senior management positions in the bank's Market Intelligence and Analysis Division and in the Capital Markets Division. His research interests include understanding policy tools and evolving financial market structures and instruments. Matt obtained a Master of Mathematics from University of Warwick and a Master in Economics from the LSE. Last but not least, we have Peter Praet, who has a long and distinguished career in policymaking, and he is a very familiar face to me and probably to a lot of you as well. He served as the ECB's chief economist from 2011 to 2019. His earlier career includes positions at the IMF, the Belgian Ministry of Finance, and the National Bank of Belgium. He holds a PhD in economics from Université Libre de Bruxelles. Let's start with you, Zornitsa. You work in one of the major global dealer banks, so it will be very interesting to hear your views on trading conditions and market making in government bond markets.
Good afternoon, everyone. Thank you, Karolina. My name is Zornitsa Todorova, and I'm head of Thematic fixed income research at Barclays. I'm really delighted to join today's panel. We're here to talk about government bonds, which are traditionally seen as safe assets, but I think as my fellow panelists will agree, in today's market, that label deserves a closer look. So let's begin with a fundamental divide in government bond markets, and that's US Treasuries against European government bonds, or EGBs. So on the surface, both are sovereign debt instruments, but structurally, they operate in two very different worlds. The US Treasury market is a single, standardized market which has very deep interdealer and dealer-to-client liquidity. So it is one issuer, one benchmark, one market. I like to think of this market as a more scalable and a more cohesive ecosystem. And that stands in very sharp contrast to the picture that we have in Europe, where we have a more fragmented landscape with several different issuers with varying degrees of credit quality. There is no single EU-wide safe asset, and trading is really dispersed across a variety of trading venues. And sometimes even the popularity of these trading venues depends on the location of the issuer. We have MTS, we have BrokerTec, we have TradeWeb, we have Bloomberg. It's a more fragmented picture, and liquidity is unevenly distributed. So for example, Italy's BTPs are really deep by volume, but bonds are deep by cost, but there are also other issuers which have relatively thin liquidity. But I think that the important point to make here is that this divergence isn't theoretical. It shapes how the entire market operates, from how monetary policy is transmitted to how resilient these markets are under stress, and down to how investors execute trades and how dealers intermediate those trades. So over the last couple of years, over the last 5 to 7 years, we've witnessed a secular and structural shift in bond markets. They are becoming faster, more agile, and more electronic. They're actually mirroring trends that we've observed for a very long time in equity markets, and we at Barclays Research call this trend the equitification of bond markets. And one of the clearest symptoms of the equitification of bond markets is the rapid rise of electronic trading. Government bond markets lead the way in that aspect, and we estimate that about 70% of total notional traded is executed electronically, and that is a striking contrast to other pockets of the fixed income market, such as credit markets, for example, where electronification is at a different scale. So, for example, on this chart, you can see that in high-grade credit, that level of electronification stands at about 50%, and it goes down to about 20 to 30% in more opaque asset classes such as high yield credit, for example. However, the degree of electronification in government bond markets is very far from uniform, and I think Europe is a very good place to illustrate this. For example, Italy's BTPs lead the way with more than 80% of notional executed electronically, but when, for example, we look at bonds, that number stands at about 50%, and when we go down to smaller issuers such as Greece, for example, the level of electronification that we observe in these markets is on a very different scale. We're talking about maybe 20 to 25%. Why is this important? So electronification brings speed, it brings transparency, it brings efficiency to government bond markets, and at the same time, it reshapes the role of dealers in this market who remain really critical for its proper market functioning. We all know that balance sheet space is costly today, and as a result of regulatory constraints since the global financial crisis, dealers need to be extremely selective in the type of risk that they choose to hold in their inventory and their positions. And meanwhile, the size of the government bond market is expanding. And it's not only about issuance, but it's also about the number and the breadth of investors that participate in this market, which also means that the number of orders that need to be processed and executed on a daily basis is really rising quite a lot. We estimate that we have more than 5 to 10 times more orders today compared to a decade ago. However, at the same time, we see another parallel shift, and that is that investors' tolerance for illiquidity has really collapsed. I think this is an important theme that we don't often hear much about, but it's crucial to understand because investors demand near instant liquidity, and they demand near instant liquidity because of the way their strategies are set up. So they need the liquidity now, and sometimes they need it in large size, which can be a tall order, especially in more fragmented markets or when markets are stressed. And so it's no surprise that in this kind of environment, the market is shifting towards more electronic execution and electronic market making. And that brings many advantages, more transparency, as I was mentioning earlier, more data points and price points, faster price discovery, etc. It also opens the door to alternative non-bank liquidity providers, which really thrive in electronic venues, but which do not warehouse inventory. And the result is that we have a secular shift towards more electronic trading, and bid offer is tightening. But at the same time, platform fees have remained remarkably sticky. And in my view, this is a disconnect that is often overlooked in broader discussions, that in fact, as that dealers absorb more cost as markets become more electronic. And I think the paradox here is that the economics of dealer intermediation are becoming less attractive precisely at a moment in time when the need for it really intensifies. So I think that technology is really transforming execution for these safe assets, but in my view, it hasn't replaced human judgment yet. And we hear a lot about the rise of AI, improvements in technology, and what comes with all of that. But the fact remains that government bond markets remain extremely structurally complex. And I think a good example to illustrate this is, again, electronic trading. I mentioned earlier it's at 70%, but it has been gravitating around that point for the last 2 to 3 years. And it's way below what we observe in equity markets. And I think to me, this shows that there are some structural limits to automation. And that's because even in stable markets, there are many strategies in this place that don't necessarily lend themselves that well to electronification. Take the bond basis, for example. It involves multi-leg execution that sometimes is managed better by voice. Another example are large trades, in which case dealers often need to commit capital in order to provide a service to their clients, and that service involves minimizing price impact and also preventing information leakage. But it is really when markets are stressed, when voice trading steps in, and it's up to the role of traditional dealers to provide that liquidity. When algos log off, And when they log off, and that additional layer of liquidity that we normally see in markets and that market participants are used to seeing disappears, then that can lead to pressure building in government bond markets. And to echo the title of our webinar, this is when these safe assets can actually start to look unsafe. And it's not a challenge that is only applicable to small issuers and illiquid markets. We also see it in larger, well-developed, extremely deep markets such as the US Treasuries market. And here I'm going to borrow from work from Michael Fleming here, who shows that during periods of stress, such as, for example, the COVID-19 outbreak or later on the SVB crisis, the depth of the electronic order book in US Treasuries can actually very quickly evaporate. And we see similar dynamics in credit markets. That's the chart to the right here. For example, sometimes when corporate bond prices decline quite a bit, this is typically triggered by downgrades or earnings surprises. What we observe is that the level or the share of electronic trading rapidly wraps from about 50% to 40%. And it rebounds very quickly afterwards as volatility subsides. But the important thing to notice here is that during those 2 to 3 most critical days, it is really up to voice trading and dealers to step in, provide liquidity, and support price formation in the market. So, of course, government bond markets are different in that sense, and we wouldn't see such idiosyncratic volatility events as frequently, but I think that generally speaking, some of these conclusions would also hold in that market as well, especially when we talk about maybe less liquid and smaller smaller issuers. There are several key themes that begin to emerge even as early as this point in the discussion, and key among them are really liquidity, price discovery, and fragmentation. And I think that some of these challenges are a bit more acute and a bit more pronounced in Europe because of some of the key themes that I was mentioning earlier. But this might change with the launch of the European Bond Consolidated Tape, which is going to happen in 2026. The European Bond Consolidated Tape is a centralized repository which is going to contain information on all bond trades executed in Europe. It's going to show prices, exact quantities, and timestamps. And it's going to look very similar to the trace model that we have in the US market. And we estimate that about 90% of the trades are going to be displayed in real time, and the remaining 10% are going to be deferred. The rules are quite complicated, but generally speaking, the idea is that the less liquid an instrument is and the larger the trade size, then the longer the deferral will be. And I find this very interesting because it is a different model to what we see with FINRA's model, for example, which at the moment shows trade level transparency for on-the-run treasuries and displays that information as of end of day, but excludes off-the-run issues. The European model is more comprehensive in that sense and is going to show both on the runs and off the runs. Now, I think that this is an important step towards a more efficient market, towards better and faster price discovery. However, it might not come without its trade-offs. It is very well possible, and this is what our research so far suggests, that some of the larger trades might become costlier to execute as dealers struggle to unwind their positions in full view of the market. But as I said, it's an important development and an important step forward. It surely would not solve all the issues of fragmentation, but I believe that it's going to lift some of these constraints that we have observed in European bond markets. And so finally, if I had to summarize my thoughts on the topic in just a few sentences, I would say that we live in very exciting times, and as the government bond market grows bigger and bigger, and as it gets more electronic, I think the big challenge is really to build resilience into the system, to evaluate very carefully what the role of dealers is, and to make sure that we integrate algos, which are becoming faster and better at pricing and executing, with the human judgment, which especially when markets are a bit more stressed is absolutely fundamental, and combine these two perspectives in a very cohesive and resilient ecosystem rather than think about whether we should replace one model with the other. And I'll pause here and I'll back to you, Karolina.
Thank you very much, Zornitsa. Very interesting. Now, Michael, your work was cited there and on the U.S. Treasury market, and of course you have a long experience with the market for what we think of as the world's safe assets. So, what are your views on liquidity and intermediation?
Well, I appreciate the invitation to participate today, and thank you for the kind introduction. Before I go on, I should need to provide a standard disclaimer that views I present today are my own and not necessarily those of the Federal Reserve Bank of New York or the Federal Reserve System. 3 questions I'd like to cover in my opening remarks. What is the current state of Treasury market liquidity? How does the market structure affect liquidity? And where does market reform stand? How I measure liquidity. So I think of market liquidity kind of pretty simply is the cost of quickly converting an asset into cash, or vice versa. Even this simple, really simple definition has kind of multiple dimensions to it. The cost of trading, how quickly the trade can get done, and of course you need to think about the quantity that you want to trade. Because there's really no single measure that captures liquidity, we tend to look at a number of different measures. The ones I like are bid-ask spread, difference between the highest bid and the lowest ask price, depth, the quantity that can be bought or sold at various prices, and price impact, how much prices change for a given quantity bought or sold. So what are the measures saying? This chart plots moving average of average daily bid-ask spreads for the most recently issued 2, 5, and 10-year notes. I'll point out that the 10-year note is on a different axis, so it's actually, the spread is actually twice as wide as for the 5-year note. It's not, they're not the same. You see spreads, they don't vary much of the time, but they did widen very sharply in March 2020 around the COVID disruptions, in March 2023 around the regional banking turmoil, and then again in April of this year around the tariff announcements. I'm going to show you the same chart you saw before. This is depth, but I do have it updated through July of this year. And yeah, Zornitsa showed this as well. It's this shows average limit order book depth at the inside bid or inside offer. And there's more variation in this measure. In fact, there's so much variation that I plot this on a log scale. So for the 2-year note, for example, average depth was something like 80 million in the weeks before March 2020, and then it plunged about 90% to 8 million, during the pandemic. Depth also plunged in March 2023, and again in April of this year. This is the last liquidity measure I'll show you. It combines the price and quantity aspects of liquidity. So the idea here is every trade, of course, has a buyer and a seller, but we'll call a trade a buy if it's initiated by a buyer and a sell if it's initiated by a seller. And then, so what we do is for each minute of every day, we calculate the price change and we calculate net buying volume, that is buy volume less sell volume. We regress the price changes on the net order flow, and we get this regression coefficient, which is basically a price impact coefficient, how much the price changes for a given amount traded. And it's really a consistent pattern with the other liquidity measures, a big spike up in March 2020, some widening in late 2021 and early 22 as the Fed started tightening, and then a spike in March 2023 and in April of 2025. One of the points that Martin made, and which I will reiterate, is that volatility is a key driver of illiquidity. This chart just shows realized price volatility for the 2, 5, and 10-year notes, and you notice a very similar pattern as we saw for price impact or for depth, with these spikes in March 2023, and in April of 2025. We're going to look directly here at the relationship between volatility and liquidity. So on the x-axis, we plot average daily average volatility by week for the 5-year note. And on the y-axis, we plot average price impact for the 5-year note. And I've switched here to implied volatility, but you see a generally similar pattern if you look at realized volatility instead. And what you see is a pretty tight positive relationship between these two variables. Volatility is higher, liquidity is worse. I've put the 2025 points in blue here, so you can see they're kind of generally to the upper right, but fall right within the scatter. I've also put the March 2023 points in purple. Those are in the upper right. And then the March 2020 points in red, which stick out a bit. The March 2020 points, it looks like liquidity seems to have been somewhat worse than would be suggested by the level of volatility. In a paper with Professor Darrell Duffy, as well as current and former New York Fed colleagues, we conjecture that dealer capacity might help explain the behavior of liquidity, and especially at a time of market stress, such as in March 2020. So what we do is we look at various measures of dealer risk-taking, such as net positions. We adjust them for the riskiness of the positions in the market, and we ask how much risk each dealer is taking each day relative to its sample maximum. So that is, we're kind of constructing a novel realized capacity utilization measure. And we plot here the average across dealers and across measures. And what you see is that dealer capacity utilization was quite high in March 2020, right when liquidity was unusually poor given the level of volatility. So again, this comes back to Martin's point that not only is volatility an important driver of liquidity, but it seems that dealer intermediation capacity may also be an important driver. So in this next slide, we just directly compare dealer capacity utilization to so-called residual liquidity. So the dealer capacity measure is the same as on the last slide. Residual liquidity is just the liquidity that's not explained by volatility based on a simple least squares regression. And what you see is, it might be a little hard to see, but you've got these green dots in March 2020 that are really high right when dealer capacity is high. So again, this is just providing some evidence that liquidity was unusually poor in March 2020 because dealer capacity utilization was so high. So I think, the reason dealer capacity, matters basically reflects the treasury market structure. And again, Martin touched on this earlier, but this is just a simple depiction of the treasury market structure. We have clients or customers. You can think of hedge funds, mutual funds, pension funds, insurance companies. When they want to trade, they trade with dealers, not with one another. So they could trade directly with dealers through instant messaging or phone, or they could trade indirectly with dealers through request for quote platforms like TradeWeb and Bloomberg. You then have the dealers, often typically associated with banks. So JP Morgan, Morgan Stanley, Goldman Sachs, they trade with the customers. They also trade with one another. When they trade with one another, it could be directly. So I should probably have a solid black line between the dealers there. But mostly they trade through interdealer brokers. And then a prime example of an interdealer broker would be the Chicago Mercantile Exchange's BrokerTech platform. And these interdealer brokers, they intermediate trades between dealers, but they also open to other professional traders about 20 years ago, and in particular to principal trading firms, but they are not open to customers. Given the events of March 2020, given this market structure, there have been a lot of initiatives in recent years to promote market resilience. Now, I grouped these initiatives into 4 categories here, but I really think the 3 most important would be our standing repo facility, expanded central clearing, and increased data availability and transparency. The SRF that was established in 2021 provides liquidity to dealers and certain depository institutions against eligible collateral. It supports monetary policy implementation, but it also provides a liquidity alternative to sales, helping prevent fire sales. The range of counterparties for the SRF is somewhat narrower than some market commentators have suggested, and somewhat narrower than other central banks, but this is still an important step towards promoting market resilience. Expanded central clearing, the SEC adopted rules in late 2023 to expand clearing. It requires central clearing of all cash trades intermediated by IDBs and repos and reverse repos in which the counterparty is a CCP member. This brings several benefits. It brings kind of standardized, robust, transparent risk management practices to an increased number of trades. This should reduce firms' settlement obligations and associated risk exposures, which could increase dealer capacity. And it also reduces the credit risk associated with bilateral transactions, which could make it easier for direct trading to arise between non-dealers. So again, it could get at the market structure issue. Lastly, data availability and transparency. I'm going to kind of echo some of the points Zornitsa made. Data availability helps the public sector identify and address market vulnerabilities. It also facilitates better informed decision-making, and it supports market liquidity by the private sector. As Ernest said, data on individual transactions is now available end of day for on-the-run securities in the Treasury market, but not for the off-the-run securities for which trading activity and pricing is more opaque. There have also been improvements in the repo market, where the OFR has approved rules for collection of data on non-centrally cleared bilateral repos. Yeah, I mean, in terms of these, we have really these three main items: standing repo facility, expanded central clearing, data availability, and transparency. Really, a lot of progress has been made. As I said, the SRF's been established, central clearing, rules have been approved. The data availability and transparency, that's been coming along, but I think there's really more progress that could be made available there, and especially for improving the transparency of off-the-run securities. So, thank you.
Thank you so much for that, Michael. Very interesting, that too. Let's turn immediately to Matt. I read from Bloomberg News today a headline saying that Britain's budget troubles are back rocking the bond market again. Now, does that mean that we can expect that the Bank of England may have to step in as market maker of last resort, similar to what happened in connection with the 2022 market stress?
Thanks for that, Karolina. I'll try and avoid answering that question directly, but I will touch on the issues of market maker last resort in my remarks. Yeah, thanks for the opportunity to speak today. As you said in your intro, Karolina, I'm head of sterling markets at the Bank of England, which means I'm responsible for our operations in sterling money markets and the gilt market. And I've worked on government bond markets from various angles during my career at the bank, and they remain, as you can imagine, a topic very close to my heart in my current role. So yeah, I'm going to cover primarily two key topics. First, the lessons learned from the 2022 LDI gilt market episode, which I witnessed firsthand, and then questions around the market maker of last resort role, as well as non-bank financial institution, or NBFI, access to central bank liquidity facilities. And I'll briefly touch on central clearing of repo at the end, touching on the theme that Michael talks about there. Okay. So yeah, let's take us back 3 years to the autumn of 2022. Government bond yields globally had been rising through much of that year. So gilt yields went from around 1% in January to around 3% in early September. And then in the wake of the UK government's September fiscal statement at the end of that September, we saw extraordinary volatility in the gilt market, volatility on a scale that none of us had ever really witnessed before. The market became extremely one-sided with a rush of sellers and a real lack of buyers. Liquidity in long-dated gilts, particular, simply vanished. And put that in context, the liquidity the yield on the 30-year gilt yield, jumped about 130 basis points in just 3 trading days. So that's 3 times bigger than any historical move over a similar period. Now, this triggered a cascade of consequences, especially for the liability-driven investment, or LDI funds, and it's probably everyone's familiar with now. These funds are, which are really heavily relied upon by UK defined benefit pension schemes, found themselves exposed as gilt prices fell sharply. Their leverage spiked. They faced enormous margin calls that they struggled to meet, especially the pooled funds who manage investments from sort of a large range of different pension schemes, and those pooled funds were the ones which were most exposed. Now, crucially, this was a liquidity issue, not a solvency issue for the underlying pension schemes. The higher yields helped their overall funding position, But attempts to recapitalize through pension scheme cash simply couldn't keep up with the speed of the crisis. And that forced LDI funds to start selling gilts into an already thin market, creating that vicious cycle: more sales, falling prices, and vanishing liquidity, overwhelming dealers' ability to intermediate, which sort of speaks to the theme from the previous two panelists. At its worst, the market dysfunction posed a real risk to UK financial stability by causing an unwarranted tightening of financial conditions and a reduction of the flow of credit to households and businesses. And so at that point, the Bank of England stepped in. We announced a temporary and targeted intervention, buying long maturity gilts for a time-limited period to halt the downward spiral and give LDI funds enough time to stabilise. And in total, we bought just over £19 billion of gilts in a matter of weeks, and then we sold them back in a timely but orderly fashion once markets had calmed down. Now, that experience was a stark reminder of the fragility that can emerge in core markets and the speed at which leverage and illiquidity can combine, especially when they meet those dealer intermediation constraints. And the episode also highlights the critical role that central banks must sometimes, in exceptional circumstances, play as backstop to preserve stability. So let me talk about that a little bit more. I'll start by outlining some of those sort of key principles that have been guiding our thinking on extraordinary central bank interventions, particularly when it comes to restoring orderly functioning in core markets like the gilt market. Now, much of this builds on international central bank work, including with the BIS, and reflects lessons learned from past market turmoil, various episodes that have already been mentioned by panelists. Now, first and foremost, those central bank financial stability interventions, like the one we undertook in the gilt market in 2022, should always be viewed as a last line of defence. They are there as a backstop to protect markets that matter for financial stability and should never be a substitute for private market self-insurance or to support individual institutions. Firms, including non-banks, need to take primary responsibility for building up their own resilience against all but the most severe shocks. Of course, the bar has to be set really high for public intervention because too much reliance on central banks to bail out markets risks creating moral hazard and could ultimately end up costing the public purse. So the vast majority of the time, we want markets to self-stabilise. That said, we all know there are rare extreme scenarios, those tail events, where market dynamics become severely self-reinforcing and a system faces risks that go well beyond economic fundamentals. And in those cases where market dysfunction in core funding markets genuinely threatens the stability of the financial system, then and only then, extraordinary central bank action may be justified because the cost of not acting is even greater. Now, if and when the central bank does have to intervene, the design of those interventions matters enormously. We aim to keep our footprint as small as possible to limit any distortion to market pricing and to support the private sector's capacity for market making and price discovery. So let's turn to sort of tools we've got at our disposal. Now, broadly, there are two main options for a central bank: collateralized lending or outright asset purchases. In general, lending operations where the firms can borrow from us against collateral should be our first port of call for several reasons. First, lending operations are less likely to interfere with the stance of monetary policy. They're time limited by design. Once the loan matures, liquidity is withdrawn, and that makes the exit strategy much clearer. Second, they reduce moral hazard. Unlike outright purchases, the assets don't leave the private sector balance sheets, and that better encourages prudent risk management by the firms. Third, those lending operations limit the central bank's financial risks. Because we lend against collateral and so we can manage risk through margin and haircuts, our exposure only materialises if the counterparty defaults, and compare that to outright purchases where we're taking on that direct exposure to the change in asset values. And then finally, lending can actually be better for the non-banks themselves because asset fire sales can be extremely costly. It's far better for them to borrow liquidity in distress and sell at distressed prices. Now, of course, lending might not always be effective. If market dysfunction is being driven by an urgent need to delever, then firms may not want to take on more borrowing or be able to. And in those situations, asset purchases can be the more appropriate route. And that's what we saw in the LDI episode. The imperative for funds to delever meant that outright central bank purchases were the most effective tool. Now, when we undertake asset purchases for financial stability reasons, it's essential to distinguish them from asset purchases intended for monetary policy. The motivations are completely different. Financial stability purchases are all about restoring market functioning, not about targeting inflation or monetary conditions. And that needs to be clear in both the design and in how we explain our actions to the market. Moreover, any exceptional intervention should be accompanied by strong action from regulators and macroprudential authorities to identify and address the underlying vulnerabilities that led to dysfunction in the first place. So let me tell you a bit about how we applied those principles 3 years ago in the LDI episode. I mean, in short, our intervention was temporary, targeted, and had backstop pricing. So our purchases were temporary. We strictly limited them to a 13-day window from late September to mid-October. We targeted the assets most affected by the dysfunction, starting with long-dated gilts, and then we expanded to index-linked gilts as needed. And we implemented a backstop pricing approach, so only buying at relatively distressed prices, and ultimately purchased far less than the announced maximum. Now, crucially, the unwind began very promptly once market risks receded, and we adopted this timely but orderly demand-led approach, allowing market participants to express interest in buying back gilts from our portfolio. And so we managed to complete that relatively quickly without reigniting any market stress. And then finally, our intervention was matched by coordinated regulatory action. The bank, alongside pensions regulator and the FCA and relevant EU authorities, worked quickly to identify weaknesses in LDI funds and pension schemes and take steps to increase their resilience against future volatility. Now, whilst that intervention was a success, as I say, lending operations are often preferable, and that's why we've developed a new tool in our toolkit, the Contingent Non-Bank Financial Institution Repo Facility, or CNRF. We love an acronym. Essentially, this facility is designed to be activated if we see a repeat of the sort of severe gilt market dysfunction, those moments when financial stability is at risk, because non-banks suddenly need a lot of liquidity and might otherwise face no choice but to fire sell. And through this facility, the CNRF, we can lend gilts for short periods directly to eligible insurance companies, pension funds and LDI funds. Now, because this is a contingent facility, we've got discretion over when we activate it. It's intended for those critical periods when market dysfunction could threaten UK financial stability. And it has inbuilt flexibility as well, meaning we can adjust the terms or pricing as needed to match the situation at hand. And if and when we judge it's necessary to activate the CNRF, we'll ensure it's suited to the market's needs at that moment. Of course, as a backstop facility, we'll set pricing to be unattractive relative to normal market conditions, but attractive relative to stress in those situations when we would activate it. So in short, we've got the CNRF, which is a flexible, responsive backstop designed to support the gilt market when it matters most. We've already had a lot of interest from firms in applying for the CNRF since we launched it earlier in the year, and I'd really encourage all eligible firms to take a look and get in touch if you have any questions. My teams will be really happy to answer any questions and support you through that application process. Now, let me finish by saying a few words on central clearing of government bond repo markets. Now, come to no surprise to anyone here, obviously a well-functioning and resilient repo market is crucially important in its own right and to government bond market functioning more generally. And greater market resilience also reduces the likelihood we'll need to intervene as a central bank. However, recent stress episodes and the Bank of England's recent system-wide exploratory scenario have shown again how vulnerabilities in the gilt repo market can generate those sort of financial stability risks. So, of course, we're very interested in improving the resilience of the gilt repo market. And as we highlighted in our most recent financial stability report, we're planning to engage directly with the industry through a forthcoming discussion paper. This will invite views on a range of possible approaches for strengthening the gilt repo market, including measures such as expanding central clearing, but also setting minimum haircuts for gilt repo transactions that aren't centrally cleared and various other things. So I would strongly encourage everyone with a stake in the market to contribute their perspectives as we look to address these vulnerabilities together. So that's coming soon. Watch this space. Let me wrap up with my remarks by saying, look, my experience during the 2022 stress really underscored the importance of that robust risk management, the resilient market infrastructure, and the need for effective central bank backstops that are used only in exceptional circumstances. Our focus must remain firmly on building resilience across the financial system, particularly among non-bank institutions, while ensuring our policy responses are measured, targeted, and always support rather than supplant the healthy functioning of private markets. The Bank of England continues to work in partnership with domestic and global bodies to address these challenges, ensuring the gilt market remains robust and a reliable cornerstone of the UK financial system. Thanks.
Thank you so much, Matt. That was very helpful. I now turn to Peter. Well, as a very experienced policymaker, who has been dealing with financial stability problems. What are your views on this safe asset debate and bond market functioning?
Thank you. My impression is that the presentations were really excellent. So I will try to add a few things to that. There were some very important policy questions which have been, raised, including the last presentation we had. So let me start by saying that, when I compare, all these efforts to improve market functioning on one hand, and on the other hand, the worrisome developments in fiscal dynamics, it looks a little bit pathetic. A lot of efforts, but on the other side, the fundamentals, continue to deteriorate. So there is a sort of race, that you try to bring answer while the fundamental problems, of debt sustainability is there. I think in the introduction of Ernest, he put it very nicely in his introduction. The fundamentals have to be right. So that's my first reaction to. So it's a bit pathetic. It's a bit sad. The way my comments will be first on central bank. I will not call it, as market maker of last resort, but central banks as good friends of last resort, because usually, as Gunnar Meyer has nicely said, safe assets are a good friend. Now central banks have intervened, and they are considered as the good friend of last resort. And to my sense, a little bit too often. I think the Matt presentation was really excellent, trying to show what are the safeguards when in the toolbox of central banks, in terms of crisis management. These interventions, market interventions, are now considered as a standard practice in the toolbox. I think it's extremely important to, specify the conditions under which the central bank would make these interventions, and especially the exit of these interventions. I think when we look ex post, what happened in the UK and what was explained by Matt, I think this is extremely interesting, and I think other central banks should try, to a little bit be transparent about how they see the framework. And I have in mind, of course, as many in the audience, the TPI of the ECB, because the TPI, basically the transmission protection instrument, talks about last interventions of the central bank to address market fragilities, market dysfunctioning, not related to fundamentals. We know how difficult it is, but you need to have specified these conditions. I think, Mal explains that pretty well, I think. And the second is the credible exit. Now, as Ernest was saying in the beginning, central bank independence is absolutely key, because if you say, in some conditions, the central bank becomes the sort of good friend of last resort, not only the good friend of markets, but the good friend of government of last resort, I think the independence of central bank is absolutely key, because the whole constructions, can be destroyed. And of course, everybody here in this audience is aware of the debate in the US, of course. And so many have that in mind when they say, government bonds are not as safe, as we thought they were. So I think this is something we have to keep in mind. Let's not forget, Mike, that in the Dash for Cash episode, the Fed, exchanged 1.6 trillion against 1.3 trillion reserves in a very short period of time. So you need huge credibility when you do that, and there should be no doubt in the market that you will exit very quickly from that sort of operation. And again, I think the geopolitical and political developments, we insist on that very much, and I think the central bank should, talk a little bit more about that. I think the Bank of England is a very good example. The US was successful also, but I mean, this was really special, was related to a COVID shock, and Bank of England is much more interesting, I would say, because of a fundamental problem in the market. Not only, the issue of LDIs, but basically a fundamental fiscal issue. So I have the impression very often, and this has not been said by Matt, for example, is that, of course, it worked pretty well with hindsight, but we never know, how markets will incorporate the good friend of last resort attitude of central banks ex ante in its behavior. When you leverage a trade or whatever, the risk distribution is somehow truncated. Of course, if the conditions are very hard, very harsh, of course, then it may limit, you know, the moral hazard. But I mean, this is not yet sure. It's an open debate to what extent central banks' interventions, you know, produce some form of moral hazard, you know, in the markets in general. And again, I come back with my first observation. It's a bit pathetic to see, you know, all these efforts that you mentioned, and on the other hand, the fundamentals which really are deteriorating. I think this contrast is quite well, quite interesting, if I can say. The second comment is on the legacy of QE. The central bank footprint in government bond markets is still extremely important. Well, first, it was very important. When you look at the euro area, between 15 and 21, the euro system bought, you know, the equivalent of 40% of GDP in government bonds, 40% of GDP. If you look at the OECD, it peaked at 16 trillion of government bond purchases under QE. It's now around 10, 11 trillion. Still, that's my point. That's still 10, 11 trillion on the balance sheet, you know, of central banks. It used to be at maximum in the OECD 29% of the outstanding debt, but it's still something like 18, 19% of the outstanding debt. So I think this process of normalizing, I will call normalizing the balance sheet, the QE stance portfolio is still ongoing. It's not finished. So it will be very important, I think, for the central banks to specify, you know, the operational framework. And, you know, most of them have done that already, like the ECB, for example, in this normalization process. But if you talk about the ECB, it's not yet calibrated, you know, how the balance sheet of the ECB will be once, you know, the excess liquidity has more or less disappeared. The inflection point is coming. In the US, we see that very clearly. It's not very far away. And so there are a lot of discussions in the US about the structural portfolio and things like this, you know, what will be the maturity, what will be the size, etc. There's a lot of very interesting paper, including by Chris Waller recently, about how the balance sheet of the central bank would be. But there are very different views about this. And I think it matters a lot, you know, in the bond market in our discussions. So that's more structural than the previous one, which was sort of QE, stability QE, you know, central bank balance sheet capacity to intervene in markets. The point also about the balance sheet of the central bank for stance reasons, if you hit the lower bound, which fortunately we don't see for the time being, but who knows, what if, you know, you reach the lower bound, you know, and what is the balance sheet capacity of the central bank? I mean, we don't have time to discuss that, but that's not an easy point. Now, if I go, my third point, and there are many things to discuss, I admit. The third point is about the fundamentals of our supply and demand conditions. I think that's quite interesting in the presentations we had. I like this comment that was made about the collapsing tolerance to illiquidity. I think that's a quite nice expression. I put it in my notes as more price sensitive investors, more price sensitive and more interconnected you know, investors in the bond market, participants in the bond market. So what you see on the supply side is basically that the net supply of fixed income bonds in the OECD as a whole is going to be, I mean, now currently 3 trillion per year. It was 2 trillion, you know, in 21, 23. And it was zero between 25 and 2019 because of, you know, net purchases of central banks. So you have a 3 trillion on a year basically increased supply. So when the central bank, you know, exits from the market, which is a big increase. And so the market so far has absorbed that quite smoothly. I think this is remarkable so far. The absorption capacity in marketing, with all what we discussed before, is that this you know, huge net issuance on the market, supply on the market, has been absorbed quite well. So that's the good news. The point, of course, is that when you look at the composition of investors, and this has been said, I pretty much agree with that, is that there have been fundamental changes. Usually in my time, basically we were making the distinction between, the price insensitive investors and the price sensitive, or the long-term investors versus, more the trading community. I think this distinction is getting increasingly blurred. One of the reasons, one of the examples is that insurance and pension funds have use extensively derivatives to hedge their portfolio, to manage, their interest rate risks. And of course, they do that with counterparties, which are basically non-bank financial institutions, a lot of them. And these are short-term, participants in the markets. And so the interconnection between the long-term investors and the non-bank financial institutions, and part of them, the short part of them, I think is quite a very important behavioral change in the market. But there are many other things in the market. The second one is, in terms of buyers, is the buyers of the central bank in the foreign exchange reserves, in their reserves. As you know, they are switching out to some extent from US assets, going to other assets. It's still relatively moderate, but you see also the increase of gold as the good friend, in times of crisis. So you see a little bit the switch there. So that's a second. I would also mention the Japanese, what is happening in Japan, sort of normalization of the environment, which is potentially, you already know, but potentially huge consequences in the relatively short horizon. I would mention another example is the Dutch pension fund. They're shifting progressively by 2028, from a more defined benefit system to a defined contribution system, where there will be much lesser demand for fixed income bonds, and government bonds in particular, compared to equities, for example. There is also this notion in the market, which I add also, which is the story that the balance sheets of the private sectors are sound, and the public sector balance sheets are not as sound as before. I think it's something I don't like very much, because in the crisis we had before, the governments took most of the risk that you had in the markets on its own balance sheet, and that's the reason why balance sheet of the private sector are relatively strong. So the markets are shifting more to private compared to the traditional safe asset. You see that in the reduction of credit spreads and the reduction of convenience yield on a lot of government debt compared to the private sector. But one of the reasons why you see the sound balance sheet in the private sector is because the government has taken most of the risk, in the previous COVID and the global financial crisis risk and the Russian, crisis that we had. So I think this is something which is still there. How can you have unsound public finances and at the same time very strong balance sheet in the private sector? At some point, this tension is going to be, to materialize via taxes or whatever. We're going to see that, but that's an open question. And my last point here before I conclude is the technology. We haven't talked. We've talked about electronic trading, but we didn't talk about tokenization. And tokenization is something that can go relatively quickly. I mean, we have it already today, but the question is, to what extent, the model that we have today with, talking about the balance sheet capacity of intermediary, I think it's still very important. But in the world in which we are going, and it can go relatively fast, I think, I would like to have responses to that question. Are we going to see an even bigger surge of price-sensitive investors, of course, because when you click on a button and then you sell your securities, you don't have intermediaries anymore. So I think these are important questions. Just as I said before, to conclude, I think and it was also in the presentation that we had in the beginning, that when you look at the euro area, you see, of course, a fragmented market. I think there was a very great summary chart that we saw. But size is key. So here, when you talk about the euro area, or even the European Union, size is absolutely key. And so you can try via, I don't know, the consolidated tape, you can try many things, but you cannot get around, the need that if you want to have a safe asset in Europe, You cannot have this collection of more or less safe assets, at the national level. At some point, you have to, to tackle the problem of fiscal capacity in Europe. And I prefer much more in terms of response to that problem. I prefer much more, people thinking about, like Blanchard, Oubide, that sort of thinking about, okay, you need this, let's make a debt exchange for a part of, of public debt. But there must be a fiscal capacity, matching these bonds, and not trying, to construct some synthetic, safe bond at European level. So I think you better tackle the problem directly. I know it's not simple, but again, it's a bit pathetic to start by my first observation, to look all these nitty-gritty efforts that you have, which I think are useful, but the elephant in the room when you talk about Europe is really, if really you want to play a role, you need a safe asset at European level. You need size. I mean, sorry, but as you know, the figures about the Bund compared to the Treasury bond, and the fundamentals in the US are probably much worse than many European countries. But of course, the convenience yield is much more favorable to the US than most European countries.
Well, that's a lot to think about. Thank you so much, Peter. I expect that the panelists would maybe want to react to some of the things that have been said. So if we start with Zornitsa, there's also a question from the chat, because one of your slides seemed to show that there's stress in bond markets days after electronic trading decreases. So it looks then like lower electronic trading could even be a leading indicator of bond stress. Is that something that you would agree with? And feel free to pick up any of the other threads.
Well, in a sense, I would, but of course, it all depends on how efficient the market is and how quickly this information is incorporated. But I think it's a very interesting fact that just when instruments are really stressed and we see lots of price pressure there, electronic trading collapses. And I think I'm glad the audience asked this question, because I think it resonates with all the other points that I was trying to make. I think it emphasizes really the role of dealers in providing a service to their clients. But yes, I would agree. I think it could be one of the leading indicators when that stress is building into the system. But of course, again, it depends on to the extent to which the market is transparent and how efficient it is. And I think I just want to make one last comment, and I think it's the presentations were all excellent and lots of interesting points were raised. But I think the one thing that resonated the most with me is really this triage or triangle between price sensitivity or price discovery, depending on which side of the equation you're at, transparency and liquidity. I think one way to look at these three things is as a virtuous cycle, right? Like you have more transparency, you discover prices faster, you have more confidence in the market, this leads to better liquidity. But it could also be a vicious cycle in the sense that with a lot of transparency, especially for instruments which don't benefit from that, all of a sudden you could see market stress propagate faster into the system, just because of market participants have the means to react very quickly with all the improvements in technology, and this could spiral and lead to illiquidity. So I think it's very important to consider all of this kind of nuances when we talk about regulatory changes, the role of central banks, and when do they step in to make sure that liquidity is supported.
Thank you, Zornitsa. Michael, do you want to respond to any of these comments?
There are a couple issues I'd like to pick up on. I mean, I guess to start, I'd like to say what kind of struck me is how much consensus or agreement there is across the panel on a lot of these issues. On the electronic trading in particular, one of the interesting things I found is the role of principal trading firms at times of stress. And I've seen like a couple of different things kind of coming out of the data. And one is during the pandemic, during March 2020, we first saw that PTFs increased their activity in the market as volatility increased. And then as stress increased, then they then they seem to withdraw, at least in aggregate. So not only as a percent of the market, but even in absolute level terms. So they seem to withdraw at a time of really acute market stress. Conversely, if we look back to another episode, you go back to October 15th, 2014, when we had the flash rally in the US, where yields kind of rapidly rose and then came back in a short 15-minute window. There you saw that PTFs increased their level of activity. Now, some of that may not have been helpful because they may have been following a trend and exacerbating the price rise, although there were other PTFs that seemed to be trading against the trend. And at least in that episode, it seems to have been hedge funds that really stepped in to provide liquidity, meaning they were kind of trading against the trend at that time. And then the one other thing that's come up in the chat is about debt market size. And I guess I would make the point there's maybe some optimal level of government debt. So yes, many years ago, I was doing work on the debt paydown in the US and how that would, might adversely affect liquidity. And then that problem went away fairly quickly. And now we're maybe at the other extreme where, debt continues to rise. And, there are concerns about, whether dealers have the capacity to manage that. So I'd say ideally, you might have some level of debt where creditworthiness is fully maintained. So, the risk-free status is fully maintained. Creditworthiness is not an issue. But you've still got like a good supply of debt outstanding to maintain liquidity.
Thank you. Well, that resonates with me. When I started here in 2022, and then the people at the debt management division, they were so worried that they wouldn't have anything to do because the debt was shrinking. And I said, I'm not worried at all. I think you will be fine. And now it's defense, it's energy, it's supporting Ukraine. So, and it's expansionary fiscal policies. So, yeah, we're fine on that front. So let's turn to you, Matt.
One part of the discussion that came up a few times was, we've been talking a lot about, and as Michael says, a lot of consensus here about the importance of building up resilience. And at the same time, as you noted earlier, government bond yields globally have been rising a lot this year, and particularly over the last few months. And there's sort of a global story going on there, and there's particular idiosyncrasies for individual countries, but there is this sort of global sort of theme of higher yields. And there's that sort of tension, I think, that we discussed. That it'd be it's a shame, to not have even more resilient markets than we have at the moment. But of course, it's better to fix the roof when it's sunny, but it's better to fix the roof full stop. And I think linking back to one of the things I said earlier, prices will move. Of course, prices will move for whatever reason. What we want to be in a position is where markets are resilient enough that they don't amplify the moves. We don't want them to make things worse. And I think that's where improving the resilience that we've all been discussing about through various different ways is so central, and yeah, in the current context, a reminder of you don't want to make things any worse.
Thank you for that. And lastly, I will turn to Peter. I have a question here from Claudio Borio. It goes like this. Over time, we have shifted from a cash flow based on a collateralized based financial system. In that context, may not the growing and widespread use of government securities as collateral actually heighten the probability of episodes in which they lose temporarily their safe haven status? For instance, ex ante greater leverage positions, ex post liquidation of collateral dash for cash. And then there's a reference there to a paper.
Hi, Claudio. It's a very good reference of Claudio. Yes, I think I have sympathy about the impact of what we call the repoization of markets, and what is the impact on incentives of market participants. So, Claudio, we know you take a negative view on this, and I think it's quite interesting to read. There are other things, Karolina, also in your job. I was looking from the OECD figures that I mentioned before, that the issuance of short-term debt treasuries, I mean, in the OECD has increased from 36% of total issuance to 49% of issuance. So when we talk about supply and demand, you can see, of course, there's more issuance, but there's more issuance of short-term debt. So I think there is a lot of things happening. As Claudio was saying about the remark of Claudio is basically a remark where you see the huge interconnections that you have between the traditional, what we call the traditional investors, long-term, players, including banks, by the way, and the non-bank, the more short-term part of the non-bank financial institutions, because the NBFI, include insurance companies and many others. What you see here is that it's much more interconnected and much more liquidity fragile. And Claudio adds to this also, there is an incentive problem in that sort of, new constellation, sort of new landscape. I mean, that's basically his point, Claudio, if I remember. But I invite also everybody to read his very good papers on this. But I think in the discussion we did, and Caroline, also this issuance strategy of treasuries in a situation where central banks are exiting from the purchase of long-term bonds. As you know, I mean, in the US, the Treasury issues a lot of short-term debt, but it's in the OECD, you see that a lot. Because the long end, it's getting more difficult, and then you go to the short end and you try to get out of this. But as long as Ernest was saying in the beginning, if you don't improve your fundamentals, I mean, what's the point? And well, it's a real issue, of course.
I am mindful that we only have a couple of minutes left. I just want to say thank you to all the panelists and for a very interesting webinar. Over to you, Ernest.
Thank you very much, Karolina. Now, this concludes this SUERF-Baffi Bocconi webinar on government bonds, unsafe assets. Now, while we focused as announced and as intended mostly on technical aspects of bond markets, I think it also became clear at the same time that you need to look at these aspects in close conjunction with the development of economic fundamentals which drive bond markets, and that the two interact. And I think Peter has made this quite clear, and also the other presentations have made this clear. Now, it only remains for me to thank Martin, Karolina, Zornitsa, Michael, Matt, and Peter for your really enlightening presentations and for the interesting discussion. And to all of you for your interest, your participation, and your questions. I'm really sorry if we couldn't cover all questions that were posed in the chat, but I'm sure that the speakers will consider them for some later studies or whatever might come out of this. Bye-bye and take care.